Open your trading chart tonight and count the indicators. A dozen lines crossing over the one thing that pays you, which is price. Every one of them is measuring the same two things, just slower. It took me years to accept that the fix was never one more indicator. Now I trade over 20 markets off a chart that carries two tools, and my analysis got faster. So I'll hand you the two that survive the delete key and the analysis that runs on gold, crypto, and a stock with nothing retuned. You open your trading chart to answer one question: which way is this market going? And the lines you piled on are the reason you can't. 𝑀𝒊𝒎𝒆𝒔𝒕𝒂𝒊𝒎𝒆𝒓 spent 10 years as a Wall Street analyst losing money. Then turned professional and won the US investing championship, and the one tool he leaned on to call direction was a single moving average. Price above it, he called a green light and looked to buy. Price below it, red light, and he would not touch a buy, regardless of the trade setup. One line did that whole job, and you are at your screen with a dozen unsure which way to lean. So here's the first tool, and it does exactly one job. On the market you'll actually trade, the metals, the crypto, the indices, the US stocks, you just put two moving averages on the chart, a fast line and a slower one, somewhere around 20 to 30. When the fast line sits above the slower one, direction is up. When it sits below, direction is down. That's the whole conversation. I call it the compass line, because a compass has one job too, and you never ask it anything else. You read it from the top down. Check the weekly time frame first for the bigger picture, then drop to the daily and make sure they agree. Say gold's weekly time frame has the fast line riding above the slower one, so up, and the daily agrees. Then direction is up. So I only hunt for buying opportunities, and I don't go looking for a second opinion. One thing, and it matters, currencies answer the same which way question a different way, of the price structure itself, of where price keeps standing. So on Forex, the compass line comes off. Everywhere else, direction is one line's job, and I don't decorate a chart to feel more certain. A line earns its way by answering one question, or it comes off. One line that points beats 12 that argue. So the compass line hands you which way in about 3 seconds. But being right about direction has knocked more good traders out of winners than being wrong ever has. Because a correct analysis pays nothing if you get bumped off the trade before the move even starts. Which raises the second question: how far? You can nail the direction and still lose on trades that go exactly where you said they would. And 9 times out of 10, the culprit is the same: the distance you picked for your stop loss. In my first year in trading, I set every stop loss the same way, a fixed number of pips, the same distance on every market, because it felt safe and it was one less thing to decide. And so, whenever the market clipped me, the story in my head was always the same one. That story went more or less like this: 20 pips has always been my stop loss. 20 pips is disciplined. If the market wants to knock me out on 20 and then run exactly to where I called it, that's the market being unfair, and I was right all along. The market, of course, does not do fair. It does volatility, and I was measuring it with a ruler I had invented. Then came the evening that fixed it. Morning routine done, order set, and checked back late to find the trade closed for a loss. I watched the same market turn within the hour and ran straight to the target I had drawn without me on board. I sat there and thought, my analysis was right and the level was right. So what on earth is broken? It took me longer than I would like to admit to see it. My stop loss had nothing to do with the market at all. I had chosen a distance that felt right to me, and a market that swings 100 points in a day will brush past a 20 pip stop loss on its way to doing precisely what you predicted. I was getting stopped out for standing too close. The day I stopped choosing that distance and let the market's own size set it instead, those quick knockouts mostly stopped. So here's the second tool, and it's the fix for exactly that. Before you set a single stop loss, you measure how far this market normally moves in a day, its recent daily range. There's a tool built into every trading chart for it, the ATR, or average true range. And all it does is tell you the size of a typical day over the last 10 days or so. That number is the market's own ruler. You set your stop loss as a multiple of that ruler away from your entry price. On a calm market, a fraction of a day's range. On a violent one, the metals, the indices, the crypto, a few multiples of it. The market hands you the distance and you stop guessing. Say gold is running around $30 of a range a day. Your entry is at 2,400. So your stop loss doesn't sit at some round number you like the look of. It goes a little past one full day's range below, around 2365. That's far enough that an ordinary day can't reach it, and close enough that you are still only risking what you planned. Because a fixed 20-point stop loss on a market whose average is 100 points is just a donation. You'll get clipped 4 or 5 times before the real move even starts. And it works because every market breathes at its own size, and one fixed number pretends they all breathe the same. Set it too tight and normal noise knocks you out of winners. Set it too wide and you are risking more than you agreed to. The ruler keeps you in the one narrow band that's actually right. And whether your stop loss is a fixed number or the market's own range, that's exactly the kind of slow hidden mistake that the free diagnostic quiz in the description below was built to find. It drains an account for months without ever looking like the problem. Get your free diagnosis today with the link in the description. A fixed pip stop loss only looks like discipline, but it is lazy risk control that hands your winners straight back to the market's noise. The best stop loss is the one that you did not choose. So now you have direction from one line and distance from the market's own ruler. And right about here, the old instinct kicks in to add a third tool, then a fourth, just to be sure. Sit with where that instinct comes from. For years, you've believed the reason you can't pull the trigger is that you haven't found the right indicator yet, that the correct one is still out there. Watch what a group of scientists filming people catch a ball does to that belief. 2 trading tools still feels too thin. A market this complicated should surely need more than 2 readings to trade it safely. And that gut feeling is exactly what keeps you adding lines and still never quite trusting the trade in front of you. Whether 2 readings can really be enough got settled places by a group of scientists filming people trying to catch a ball. For years, everyone assumed the brain had to be doing something close to genius to catch a fly ball. A ball comes off the bat at 144 kilometers per hour. In about 2 seconds, you would have to judge its speed, its arc, the wind, the sprint to the exact spot it's going to land. It looks like the hardest maths problem in sport. So in the 90s, a group of researchers strapped cameras onto baseball players and filmed what they actually do. And it turns out they calculate none of it. A good outfielder tracks one thing, and one thing only. They run so that the ball appears to travel in a straight line in their vision. That's the entire method. Keep the ball moving in a straight line and your feet carry you to precisely the right place every single time. The ball is screaming complexity at them, and they answer it by locking onto one variable and trusting the rest to follow. Nobody has ever caught more balls by adding a second calculation. The players who try to solve for the landing spot are the ones who freeze under it. And there you are at your chart tonight, a trade setup half formed in front of you, reaching for one more indicator to be sure. You freeze on the exact trade the simple analysis already answered. So answer this the way the outfielder does. The chart is screaming complexity at you, and every instinct says match it with more tools. But you just watch complexity get solved by locking onto one variable and trusting the rest to follow. So What does that make the next indicator you are about to add? It comes down to the shape of the thing itself. Every market, every single day, asks you two questions and only two. Which way is it going and how far does it move? That's the whole interrogation. Once you can see that, the chart stops being a wall of noise and turns into a two-question chart. The compass line answers the first question on the markets you trade. The market's own ruler answers the second one everywhere. And every other line you could bolt on is just remeasuring one of those two, but a half step slower. That's why more lines can't make you safer. A 13th indicator has no third question to answer, which is also why this analysis does not care what you point it at. You just run it on gold. Point it at Bitcoin, weekly fast line above slow, so up. Daily range of, say, a couple of $1,000, so your stop loss stands back a few thousand. At distance, the market handed you. Same two answers, brand new market, nothing retuned. A US stock reads the same way. And a stock where the first line sits under the slow one, direction down. I don't care how pretty the trading candle is, I'm not hunting for buy signals there. One check, one skip. Because the two tools were never the trade. They only tell you which way to point and how far to stand back. The trade still fires on price action, a level you already know, and a single trading candle that turns at it. The tools aim you. The candle says go. And notice who loses when your chart gets simpler. Nobody selling you the 12th indicator makes a single cent the day you delete it. The clutter was never built for you. Clear one chart down to those two tools and read the day's range once, and the next setup will tell you which way and how far before you are finished thinking about it. Do that and you stop being the trader drowning under his own lines and become the one who analyzes any market on the planet in about the time it takes to say it. The chart goes quiet and price is finally the loudest thing on it. And the trade you could not find under a dozen lines is just sitting there, obvious. But that obvious trade only counts if it sits at a level that actually matters. And telling a real level from the noise around it is the one piece I have not handed you yet. So watch this next. I show you how to spot the level that makes a trading signal worth taking. See you in that video.